Good afternoon, everyone. It's a gorgeous day out here. I hope everyone had a chance to get away during the weekend and do something fun. I did. That's good. Um, okay, so I'm just going to jump into this coming week. Um, Last week there was not really much surprise from the US, but obviously quite a bit of surprise going back 2 weeks to Australia, Canada, and then most recently the BOE hiking more than expected. And of course, we had the ballet in Russia, which seems to be over, but who knows? That doesn't seem over, just like the war doesn't seem over, but whatever. Um, anyway, so going into this coming week, I think the most important things are the data is on the light side. We have a PCE, which is the Fed's gauge of inflation on Friday. I don't expect that to come in much. And we have the jobless claims number, which is getting more attention every week. Jobless claims, continuing claims are steady and jobless claims are rising. Obviously, continuing claims will start to rise as well, but it looks like people are getting jobs after being on the unemployment rolls relatively fast. So again, the jobs are tight. Fed speakers last week, the most dovish is clear, and someone who's doxed himself on what dots were his is clearly Bostic, and he suggests no hikes for the balance of 2023. But then, of course, added on to that with, I don't see any cuts in 2024, at least until maybe the end. And then everybody else was more hawkish than that. And who knows, you never know what rates will actually occur. Currently the odds are one more hike and then a decent odds of a second one, and I expect July will be a hike for almost for sure, but that's a long way off. This week the auction calendar has both coupons and bills, and the numbers are very, very large. Bills that are announced, which are only go through Wednesday, are 300 billion. Bills that aren't announced include the 4-week note for Thursday or Friday. 17-week is on one day and 4-week is on the other. 4 weeks going to be huge. We could have 500 billion of bills in aggregate this week. I don't think it'll be quite that much, but a lot. And then Monday, Tuesday, Wednesday, we have $120 billion of 2s, 5s, and 7s coming to market. So I wouldn't expect that part of the curve to be able to sustain any rally on just about anything except some crazy news, which is not planned or expected. I think Powell gives a speech. I'll have to check on when. I mean, what more can he say? He said everything he needs to say until more data comes in, and more data is not coming in until Friday, and that we'll see where that is. So I have no idea whether we're going to have we could have had a pretty interesting open overnight session with the Russia thing, but it doesn't look like that's going to manifest today. Then we're into the week of the collar expiration and the rebalancing. I wrote a long thread on rebalancing, what it is. The vol targeters have no more rebalancing to do. The vol has the forward-looking vols that they use. Even the fastest moving ones are, if anything, they're stable basically, and who knows how we open in the morning, but some of the faster ones could actually start picking up a little bit if vol catches a bid. And so I don't expect anything from the vol target funds, which would generally have been buying as vol has been coming down, and now that vol is low, they are unlikely to be adding assets through a month end. The asset rebalancers, the asset allocation rebalancers are a clear sell equities, buy bonds. I've seen numbers as high as 150 billion, which I think is very large, too large, not what's going to happen. But, there's going to be that pressure. And so we'll see how it plays out in both assets. Long-term bonds may be better bid and equities may be better set for sale broadly. The collar is, going to be a magnet. We'll see a theta. We'll see the weekend overhang of Vanna flows. Sorry, of both charm, but Vanna flows and charm, but mostly charm flows, which should make the opening a little soft. And then we'll see whether we go up above, stay above, or fall below. I would expect a strong magnet Monday, Tuesday, and Wednesday, and possibly Thursday. And then who knows what happens. We'll have to see where we're at, whether the roll itself will have either a buy or a sell or a or nothing. I'll give you what I see as that plays out. I might have a Zoom, either a Zoom or a recorded or a Spaces that will cover that toward the end of the week. We'll see if it's relevant. I think it will be. I think we'll be at the strike. Okay, so I wanted to just share with you I haven't finished the last bit of text of the DSR. I wasn't planning on releasing it today, but I'll show you the most important chart, and it goes back to the chart I put in the 1116 chart. This is a update to. Hold on one sec. So this is the main chart. The dots are where things were, and the arrow is the directions that they're heading for going forward. And my view was that the U.S. was the farthest along in the global tightening phase to limit inflation, and Asia and Japan China and Japan, and even Australia a little bit, were not at all exposed to that inflationary pressures and needed to ease. And so this graph shows here, it's whether cash is king, which means cash will outperform assets, or cash is trash, meaning assets will outperform cash. So my view was Brazil, Australia, China, and Japan would have assets outperform cash. And my view were the US, Canada, UK, and Germany were going to have cash outperform assets. In addition, if you were up here, you were in a tightening, heading toward recession area, and here you were in an easing need for stimulus area. And then these were where they were. These were evolving toward one of these two areas. And when you have that, a recessionary force coming in, bonds outperform stocks. So my expectation was the only market where bonds were out going to perform stocks were the US. That, of course, was something I said at the time was not something I wanted to put on right then. I'd rather be short assets, only handling this dimension, than choosing assets handling this dimension. But it did turn out to be wrong. So where are we now and where we're heading? So firstly, Japan is in a position in which cash is trash, in that the currency is weakening, they're going to ease, they're going to provide fiscal stimulus, and all of the various things that would generally make assets work well is true, except the bond market is non-investable because the yields are essentially zero. And why, you have to depend on continued yield curve control just to survive owning bonds. And so I didn't love Japan for that reason, but I did love the stock market back then. And unfortunately, I missed it and never bought it. But as you notice here, while cash is still trash, I can't be long assets anymore at the current prices. I can't be long the bond market. I just described why, because yield curve control is the only thing that you have to count on yield curve control just to own bonds. And equities have made their move, and I think they are vulnerable to coming off. So I've gone to neutral on Japan. And this is a synthesis of all my work. It's not just my gut. China, on the other hand, its assets and assets versus cash actually didn't move much. And bonds versus stocks really didn't move much. However, I think cash is getting even more trash-like, and there's risk of cash flight from international investors who can't deal with the weakening currency. So I think cash is getting more trash, but I really can't differentiate where we're going to be in terms of bonds and stocks at this stage. It looks like stocks still should outperform bonds, but capital flight initially is pretty negative for stocks. So because that's where international investors are. And so I'm a little nervous being long stocks versus bonds there. And, this indicates that. Australia, cash is still trash, though it never was a big deal, but it's still, I'd still prefer assets, and I can't tell with bonds and stocks. Now, all these other sections are more or less the same, of countries that are tightening enough so that eventually they'll cause a recession and you want to own bonds. And so that's the big trend for the areas of the globe where you want to own bonds. The question is timing, and I'm not ready to buy bonds in any of these countries because, unfortunately, while the fundamentals are moving toward buying bonds, the prices are way ahead of the fundamentals. And so, so I don't have trades to do on that for these reasons, but I can tell you the fundamentals are moving toward bonds in these countries. They're just not there yet. And the UK and Germany in particular have had phenomenal returns in their equity markets, which I thought they were going to outperform. Down here in the dots, I thought they were going to outperform, but they've done far better than I expected. I'm just going to scroll to what I projected and what happened. And you can see, I said that bonds were going to outperform stocks, and in fact, they underperformed by 7.2%. So that was wrong. And I also said that assets weren't going to outperform cash and from this horizon, and that was wrong. But as you know, I didn't actually want to do this trade. I did want to do this trade and did it with better timing than this, but nonetheless. Now, what's amazing, though, are these numbers. These three numbers where I thought stocks were going to outperform bonds. Bonds underperformed by double digits during the last 6 months. And in most, I thought assets were going to outperform Japan. Assets were going to underperform cash in these two countries. By and large, things are working as I expected, and I'll have all the DSR, and then all the country-specific evaluation sometime tomorrow when I finish. So that's what's going on globally. As it relates to currencies, the complicated situation right now is the dollar is significantly overbought, and yet its fundamentals and it's falling, in particular against the pound, though there was some recovery as last week, and it's very strong relative to the Asian currencies. So it's falling, but overbought and overweight, and the fundamentals support it. I can't add that up to saying that, though I want to be short the pound, I've taken off the short yen. I never put on a CNY, but I am pretty bearish on CNY. I can't get comfortable yet at this price being long the US versus the pound, which I want to be short. And so I'm looking at pound euro. I haven't pulled the trigger on anything yet, going short the pound, long the euro, because the euro at least is in a is contemporaneous in terms of what's going on with the economies there. Less inflation, less growth potentially, but same timing in the tightening, that they have more to do, that they haven't done much QT at all, and inflation is persistent. So I'll give you more color on that. Gold continues to trade worse than bonds, and bonds trade badly. And that's mostly real yields and, central bank credibility, which, you pick your level, but the credibility seems to be on the upswing relative to whatever level you started at, for at least the Western central banks, who are surprising and hiking, and that's just not good for gold. So gold is weak. Then I guess the question is, are we going to have a washout in oil? Certainly hedge fund positioning, notably Philippe, anyway, whatever his name is, who seems to have puked out all of his risk about a month ago and is now shrinking. Hedge fund longs are coming down in oil, and that trade is no longer consensus, but at some level it's going to be interesting. I'm looking for XLE, which is the equity version of oil, to break down below 76 before I become interested in either oil or XLE. And we keep trying to make a run at it, but there seems to be a bounce at some level. So that's something that's on my mind. Short assets, short twos, short fives, short tens, mostly short S&P, and small, unlikely, out of the money put on NASDAQ is left for August. And so, I think the risk is the right risk to have at this stage, and plan on maintaining it through, certainly through month end regarding this collar. And we'll see if the positions need refreshing at all, and if I add or subtract anything on currencies, et cetera, as markets develop. So that's all I have for today. I have one question at this stage. One of your posts was, there's definitely a scenario where equities are at 3,500 and Z4 is at 98, played out over. Is there an opposite in terms of equivalent highest? Yeah. So so the recession island case is equities sell off hard, and that creates a cut in interest rates. 3,500 is a level, and 2% rates would be the a reasonable recession case. It's not, it's sort of my central recession case. So then the question is, what is a strong growth, strong inflation, Fed keeps trying and doesn't succeed in cutting, in taming inflation, earnings explode on the upside, instead of 250, they end up at, I don't know, call it 260 or something higher for 2024. I could easily see Z4s being, below 95 in such a circumstance, maybe even a bit lower than that. Depending on how much time it takes, we could see, I could easily see a 6% terminal rate. We've got a 5.5 incoming. We know that. It seems like that's where we're predicting. So could I see a 6%? Sure. It's not my call, but sure, I could see that. And if so, could equities trade? You're talking about, if you're at a 6%, you're talking about a long bond that's well over 4 at that point. I'd have to do some math, but my sense is you could certainly see more than all-time highs, maybe in the 5,000s, if you were to get this sort of, just hot equity market, sorry, hot earnings market and economy, where inflation is coming down but still very strong, and the Fed is not effective in keeping, in slowing the economy. Yeah, you could see that, and you're going to talk about a Z4 well below 95. So hopefully that answers. Any other questions? Oh, there's one. You still plan on selling a $10 credit put spread on? I'd love to. Hopefully I have an opportunity. This is so what I did is I sold an iron butterfly of 4320, sold the 4320 put and call, and bought a 4290, 4350 strangle against it. And I took off the put wing on that, which is the 4320, 4290 puts, for $5 or a little under $5, I think. Yeah, I'd like to sell it at 10. Sure. Bid me 10 and it's yours right now. That said, it could have been a hell of a lot more if Russia heats up overnight, but who knows? Yeah, so that would be my ideal situation. But if we're going to crash, I'm not going to sell it. But I'm not going to sell it. My point is, I'm not going to sell it at 10. It has to be 10. But if we drift toward a point where it's 10, yeah, I'll sell it for sure. I'm just not leaving an open order out at 10, I guess is what I'm trying to say, if that makes sense. Okay. And then I'd own that collar at 30 that only can lose 30, that only can be worth 30. So that would be a good outcome. Okay. That's all I got today. I think it should be an interesting week. We'll see. Talk to you soon.